With us is our buddy, Professor Richard Wolff, the economist, co-founder of democracyatwork.info, author of numerous books, most recently, The Sickness is the System, When Capitalism Fails to Save Us from Pandemics or Itself, also now available as an eBook. rdwolff with 2fs.com as well. Prof Wolff over on Twitter with 2fs. Professor Wolff, welcome back to the program. The Fed just announced that they're raising interest rates by 3/4 of a point. What does this mean? Are we expecting a recession now? How do you expect this all to play out?
Well, I think people have to understand that these are acts of desperation, and they reflect serious economic problems that are not about to go away. Until literally 2 weeks ago, the consensus belief was that the Federal Reserve would raise interest rates no more than 0.5% today, and that there would be a leisurely increase in interest rates, both by the Fed and by central banks around the world, to sort of rein in the inflation. Let's remember, a year ago they said there wouldn't be an inflation. Then they said the inflation would be shallow and short. All of that is wrong. The inflation is not shallow, it is very fast. It is not short, it's lasting a long time. And indeed, it got so much worse that there's a kind of panic over the last 2 weeks, reflected in the fact that we have a 3/4 of a whole number increase in the interest rate, which in terms of history is a very stark action. What it does is make borrowing much more expensive, literally overnight, so that anyone, business, individual, contemplating borrowing money to do something is now going to hesitate, not only because it has immediately become more expensive, but because the ramifications of everybody else slowing down, holding back, means that even if you're not about to borrow money, the economy's future, at least for the next 6 to 18 months, is now much more uncertain, much more precarious, and literally everybody is pulling back. And that means, yes, at this point, one would say a recession is a better than 50-50 probability. The only real question now is, as it always is, exactly when will it hit, how long will it last, and how deep will it cut? And those are horrible questions for us to have to confront after 2 years of pandemic, of economic crash, and of inflation, and now we're about to be hit with a recession. It really is too much, and we're going to see social trouble, tension, bitterness, division only get worse because you're putting too many of our people, the majority, under too many economic pressures with no end in sight.
So, two questions around this. First, I'm hearing that the European Central Bank is probably going to mirror what the Fed is doing. You know, the EU's version of the Fed, and I'm curious your thoughts on that. But before we get to that, you're the guy with the PhD here in economics, not me. But my understanding of what the Fed can do with regard to the economy here is that there are two things. Number one, they can invent money out of thin air and pour it into the economy. And over the last 2 or 3 years, they have done that to the tune of something like $7 or $8 trillion. There's like $9 trillion on the Fed's balance sheet right now, meaning that they've injected that money into the economy. And then the other thing that they can do is they can raise and lower interest rates, which is what they did today. It seems to me that injecting all that money into the economy, I mean, Republicans are running around going, the inflation is being caused because of too much spending, and we can't allow Biden to have any more spending. I mean, this is Joe Manchin is saying this, along with all the Republicans. But it seems to me like that, you know, $7 trillion injection of cash into the economy by the Fed would be inflationary. And they're only very slowly unwinding that, the tune of, what, $80 billion a month, if my recollection serves me right? Which of those two things, interest rates or the Fed's balance sheet, have the biggest impact on inflation and might have the biggest impact on the possibility of creating a recession?
Well, the answer is it depends on the context. Let me explain. The Federal Reserve has been injecting money into the economy for the entirety of this century. Because we had our first crash in the early spring of 2000, the so-called dot-com crash, they began pumping money in and lowering interest rates in historically unprecedented ways. And they've continued to do it for 20 years. It didn't cause an inflation for most of those 20 years because that money went into the stock market disproportionately. And by the way, the stock market did have an inflation because all of that money helped to propel stocks to record highs, making the 10% of the people in America who own a significant amount of shares much richer than they had already been, which is why they lived in the bubble world of the economy is in good shape. It wasn't. They were, but it wasn't. What has happened now is you've got a stock market so overpriced out of this world because of what was done. And remember, you lowered interest rates and pumped money in because when the stock market crashed in the dot-com crash of early 2000, the great fear was this would lead into a depression. So it was to stop that they pumped the money in. They did exactly the same after 2008 and 9 when the so-called subprime mortgage was the trigger, and then they were terrified that the stock market going down would take the economy down, so they pumped in money. As long as that money only went into the stock market, the rich could get richer, and everybody else could wonder what exactly was going on. That can't continue now because the stock prices are too high. Nobody who plays in the stock market is unaware that we've had a historical rise that can't be sustained. So now the money isn't going into the stock market. It's running away from the stock market because it keeps tumbling. And where does it go? To land, to buildings, to all the things it didn't run after before. So they start having an inflation. And the Federal Reserve now bounces back, stops increasing the amount of money because it has to change, jacks up interest rates. But the tragedy, Thom, the tragedy is this hurts the people who have a credit card balance, the people who need to buy a new or used car, the people who had been dreaming of buying a home. They're all priced out of the market by the rising interest rates. It's a bizarre way to punish those people with a policy to stop an inflation that happened because you took care of the richest people in the society for the previous 20 years. It's not a sustainable arrangement. And my guess is it isn't going to work very well. And the reason for that is maybe the most profound and difficult point. The role of the United States in the world economy is not what it was. And therefore, what our central bank does isn't the important dynamic thing that it once was. We still are an important player. What we do here matters in the world, but not the way it did before, which means our tools don't work as well, they don't work as quickly, and they can be counteracted by the decisions made in Beijing, in London, in Moscow, and so on. And the resulting uncertainty is, in the end, the killer for capitalism. Capitalism works if the people with the money are investing it, plowing it back somehow into the economy. If they're frightened, as they are today, if they're not clear where things are going, as they are today, if they look at a society ripped apart by divisions that get worse, you put all that together, yeah, we have a recession coming, and we better cross our fingers that it's only a recession and not its cousin, which is called a depression.
Right. And with regard to the European Central Bank, and I also read that the Bank of Japan is maintaining a loose money policy. They're not going down this road. What does all that mean?
Well, the Europeans, they're caught in a bizarre place. The inflation in the United States, on one hand, is good news for the Europeans, because what it means is as the price of American goods go up, the customers around the world shift out of American goods and buy instead the goods whose prices haven't gone up as much. That's just how normal markets work. And the Europeans expect to pick up a good chunk of that business. And so they're not quite so eager to mess with this situation. On the other hand, because the United States is raising interest rates, you have, and this is what we used to call the contradictions of capitalism, people with a lot of money are moving it into the United States to get the higher interest rates, and they're leaving the Europeans. And that depresses the European currency, raises the American currency. That, too, is for them export market good news, but they're worried about the United States' international position. Here's the irony. They have to be careful of what happens to the United States, even as they compete with the United States, because more than ever, especially around this Ukraine thing, they have tied their well-being to the United States. And believe me, much more than you're seeing in the press, there are debates at the highest levels across Europe about whether, having tied themselves to the United States, they made a strategic decision that they will regret.